Year to date, many companies in the S&P have performed very strongly, but Costco is not one of those. In fact, they are flat, whilst we can see Walmart themselves are up more than 14%. Not only year to date, but if we look at the last 12 months, they're up only 2%. They're trading very near to their 52-week low, and we're going to discuss why we're not buying this company just yet, the valuation it needs to meet before we consider, and a deep dive into the makeup of the company overall. Now, Seeking Alpha themselves have this company as a hold. Wall Street have it as a buy, although it is 4 out of 5, so not the strongest in terms of the rating. And if we just zoom out over the last 10 years, this is a company that, as we will come to show you, has outperformed the S&P up 528%. Now, the first thing when talking about the company we need to consider is the valuation, and on a forward P, lots of companies in the S&P are looking overvalued. We're talking not just high numbers on the valuation, but also in comparison to their 5-year average, as well as that when we incorporate growth. And Costco is no different. It's currently sitting at a forward valuation in the 40s, and Walmart, which we also believe to be expensive, is trading lower, sitting at 35. And this is all whilst investor sentiment is taking a bit of a pullback. We are seeing it sitting in neutral, whilst not that long ago it was in greed and for quite a consistent period. So one company investors on this pullback are yet to buy is in fact Costco, but that could change very soon. Not only is it trading, as we said, at a very high forward valuation, sitting around 46 based on this data, but that is above the 5-year average at 39, which even in isolation, 39 for the growth this company has, yes, it is high quality, we do believe to be very costly, and it currently offers a yield of 0.6%, which is below the 5-year average of 0.7. Yes, this isn't a very large dividend company, but it is in fact one that does time to time pay a special dividend. If we take a look, the most recent one was in 2024, where they paid around $15 per share. 2021, 2017, it looks like perhaps every 3 to 4 years a special dividend is paid, so maybe we see one in 2026 or 2027. And then when we incorporate the blue tunnel, which tells us the expected intrinsic fair value within the parameters, this company, whilst it has been increasing over time, the stock price has traded well above even the upper end over the last 12 months, telling us this one not only looking overvalued, but consistently in the last year trading at a premium. Something that may be surprising to see, didn't actually trade at a premium from around mid-2022 to the end of 2024, where it was trading in the reasonable signal, but actually we haven't spotted this once in the last 5 years where it has come below, so no severe undervaluation for what is a high quality company. And actually we've gone one step further and gone to the last 10 years. The conclusion does remain the same. Very difficult to see this in an undervalued space. Perhaps the time to consider is when it sits right at the bottom of the blue tunnel, a near undervaluation signal. Now, they did report their earnings just days ago, where we got a marginal beat on the earnings per share around 1%, another marginal beat on the revenue, and we can see that earnings per share is up 11% year on year. Revenue itself is up 8%. Bear in mind, for the valuation this company trades at, it doesn't look like it is justified given the growth. Now, their earnings were beat on what was called steady consumer demand, and if you're someone like me who does from time to time shop at Costco, it seems like these stores are continually always packed. There hasn't been a time that I can remember where I've been in the store and it has been quiet to any kind of degree, no matter what time I've been. And it looks like one of the reasons why this company is resilient to macroeconomic swings, whether we're sitting in an overall economy boom or in fact a recession, is because, as I'm sure most of you are aware, to be able to have what they call the privilege to shop at the company, you do need to pay a membership fee, and there are also some restrictions in place as not everyone is able to apply. But analysts do believe that companies like Costco will be facing a test in the next few months. We're seeing tariff-driven inflation, so perhaps prices will start to increase Otherwise, as we always say, if prices don't increase, then it's likely companies will take this burden and their margins will start to diminish, something we'll talk about as they don't have the largest margins. And the other thing they're noticing here are rising concerns about the job market, which will inevitably hit consumer sentiment. They may start to save more, spend less, even at the likes of Costco, where some products, when you buy in bulk, do tend to be cheaper. And Costco's response to any potential high cost is that they would either do one of two things, that is hold prices steady on some of their items, or in fact they wouldn't even sell products if they believed they were too expensive and consumers wouldn't buy them, because ultimately they only have a limited amount of space in their warehouses. And we can see one thing they have up their sleeve is to extend their operating hours. They believe by doing this for only a select number of people is that it will inevitably increase the spending, which is always great. That is something you want to see from companies, higher top line revenue, and that's something they're saying is now starting to pay off, where in fact this was offered in June. Highest paid members are able to shop for an additional hour in the morning, and not only that, not only are they seeing increase the prices, but members are in fact upgrading their normal account to the executive to be able to have this privilege, which has led to an increase in 9% of the higher paying membership tier. Another thing noted is that there's been stronger demand for cheaper essentials. Perhaps consumers are getting a little bit anxious, and we can see here household budgets are under pressure, soaring product prices, weakening labor market. Consumers are in fact starting to dial down on spending out, and that's led to an increase in shopping as well as looking at cheaper alternatives, something that Costco is known for if you are buying in bulk. Now, their latest earnings saw, as we highlighted, revenue increase by 8% year on year. Their margins aren't the highest, so we wouldn't really be expecting massive efficiencies, but their gross margin up 0.2 percentage points, operating and bottom line up 0.1. And if we look at the next 4 quarters, they are anticipating all of them to be growth, 3 of them in fact double digit, whilst having a 75% track record, 3 out of 4 beats. Notably, the last 2 they outperformed. And if we look towards August, in fact, 2026, so that is really their next full accounting period, the forward P sits at 45.5, which is what we would say is very costly. Again, we are going to get to the growth to really understand that in a better detail, but one thing they're doing very well is they're not essentially expanding their warehouses, but what they have within those, they are maximizing revenue per one. If we look at the most recent quarter, August 2025, each warehouse is generating $305 million every single year. If we look 5 years ago, August 2020, this was in fact $211 million. So in just a matter of 5 years, they've managed to increase sales per warehouse by around 50%. That is absolutely incredible to see. And they're continuing to increase membership card holders every single quarter, with the latest quarter generating 2.4 million members, which of course also brings in more revenue. But one of the issues that they face, and that is why the share price didn't continue to climb higher, even with the astronomically high valuation, is that the comparable sales growth wasn't what analysts wanted to see. Most recent quarter, it was sitting around 6%, which is actually a consecutive decline from the previous 2, 9 to 8%, then down to 6. So this is something that analysts will be keen to look at in the next quarter. If we see this drop even further, we could see the company continue the decline. Now, different analysts have had different reactions to the earnings overall. We have one who lowered the price target to around $1,025, still showing growth considering where the share price sits today. We have another one, again, another lowering of the target price to $1,033. No surprises that they've used the valuation to really pinpoint why they've been doing this, but this is something that's always been there. As we've highlighted, the valuation has been, and for quite some time, astronomically high. We actually have an analyst do the complete opposite, Bernstein, increasing it not by a massive amount, but $1,140. We have Morgan Stanley do the exact same. However, they're pointing this not to the growth overall of sales, but actually to their strong membership, which continues to climb, as we've just highlighted. And then Goldman Sachs also increasing it. However, this time they have pointed strong results, $1,218. Now, we mentioned growth a few times where they get an F overall. Year on year, 8% to their top line. Expected the same over the next year. That is above the sector comparison, which sits at a low single digit, only a little bit below their historical figures, so not much of a drop. Main thing though where they maybe do lack is the earnings per share. expected 8 to 9% growth over the next 3 to 5 years. Yes, above the sector, but a little bit below their historical of 10%. Main thing we really want to point out is, remember the valuation you're paying today. Does it seem fair for a company that is growing around 8 to 9% projected on the EPS moving forwards and revenue sitting in the high single digit? Let me know, maybe you do disagree and believe this is one that is a strong buy. Now, profitability, they get an A+, where gross margin is 13%, very low considering the sector sits higher at 36%, although pretty much in line with their 5-year average. No efficiencies is noted, and bottom line 3%, that is below the sector at 5%, but a little bit and only marginally higher than the historical 2.6%, although this is pretty much margins that you would expect from these kind of companies. Interesting to note though, the sector does on both accounts sit higher. They also generate 13 billion of cash from operations just in the last 12 months, which is well above their own historical at 10 billion and significantly higher than the sector that hasn't hit 1 billion. Other things we like to incorporate is how does this company compare against others in the sector. We have Walmart, Target, Dollar General, as well as a few others. Now, over the last year, including dividends reinvested, they are in fact one of the worst performers and would be the worst performer if it wasn't for Target, which is down 42%. Walmart very strong in the last year, up 30%. Dollar General, Dollar Tree, and in fact BJ's all showing double-digit growth. However, when we zoom out to the last 5 years, they overtake all the competition, up 185%, well above even Walmart. Target is down. Dollar General also down, with some poor performance from Dollar Tree, although BJ's isn't far off Walmart's performance. And then when we zoom out to the last 10 years, you can really see that Costco has massively outperformed every single one. Main thing to point out here is though, just because they've done it in the past doesn't mean they'll do it again. Past performance is not an indicator of the future. And if we do the same thing but against the S&P and QQQ, Costco has underperformed on both accounts in the last 12 months. Over the last 5 years though, it has outperformed quite significantly against both of them, even the QQQ, which was up 122%, and that also holds true over the last 10 years. Now, typically we would say consider something like the S&P if you don't want to buy a company and have the stress that it has to outperform, but it has done very well even against the QQQ, not something we see that often, but again, we must remind you, just because they've done it before doesn't mean they'll do it again. Valuation here is pretty much the largest and main concern. It's also fascinating to look at super investors, where 6 of them currently hold this company in their portfolio. Every single one, although we can really ignore the first 2 and even the third one given how small the number of shares are, but we have here Lee Ainsley, who fully sold out around 11,500 shares. Not much of his portfolio overall, but the point here is that no super investors added this company. Again, we believe it really does come down to valuation. Institutions, on the other hand, with their 68% ownership selling 25 billion in just the last year, they've bought more than twice as much, 57 billion. They've bought nearly 4 times as much in the most recent quarter. And actually, if you want to see the reverse of the trend, well, Q1, not by a massive distance, you'd have to go to Q2 2023. More often than not, in fact, nearly every single quarter, institutions are net buyers of Costco. They really do like this regardless of the valuation. And then we can also look at insiders. Whilst we would say insider selling isn't a bearish signal, they sell for many reasons, personal and financial. We note here 11 insider selling in the last year for around $29 million and 4.5 in just the most recent one. Now if we look at the underlying metrics, free cash flow per share, ideally we want consistent growth over the long term. Very rocky, no real consistency, and expected to drop into the next 12 to $16.70. Sales growth, again, remember the valuation you're paying. You're not getting double digit every single year. 8% though was recorded in 2025. And then when we look at shares outstanding, this isn't really a huge dividend paying company. Yes, they do a special dividend, but shares outstanding, they don't return excess cash to shareholders through share buybacks. It has pretty much remained very flat over the last 10-year period. ROIC though, looking very strong. This is something we want to see, 10%, to give us faith management are able to effectively allocate their capital. Very strong, double digits and increasing, sitting at 22 on a trailing 12 month and in fact 2025. Margins, whilst it isn't something we like, we did just show you this is not too dissimilar from the industry overall, sitting around 3 to 4% in the last 10 years. Free cash flow though, that is something we would like to see a little bit higher, around the minimum 5%. Finally, net debt to EBITDA, showing the strength of the balance sheet as well as correlating to the dividend safety. Below 3 is what we want. The numbers or lack of that you see below are the number of years it would take Costco to pay off all of their debt net of cash on hand. 0 pretty much across the board, and expected over the next year. It won't even take them 1 day, something we will just highlight now as well. Bear in mind, revenues are very strong. We can see they've increased their top line by more than double over the last 10 years, from 119 billion to 275. But as always, it isn't just about the top line revenue. Do we get the consistency in the bottom line? Is it increasing at a same pace? And the answer is yes. In fact, whilst revenue has increased more than double, we've noticed their bottom line nearly quadrupled from 2.4 billion 10 years ago to just over 8 billion. That is something we love to see. Efficiencies are there in the numbers. And nothing is a quick health check. Total cash versus total debt. Cash has increased over the period nearly 4 times, from 4.7 billion, now sitting at 15.3. As always, one number here in pure isolation will never give anything away, so we compare it to their total debt numerically and directionally, which yes, has been increasing, although inconsistently, from 5 billion now to 8.2, but as we just highlighted, cash is far superior, and as we just said as well earlier, it won't take them 1 day to pay it all off. Great thing for any company that you are invested to have. And just before we jump into our valuation, we have released our latest free weekly article. We run through severely undervalued stocks every single Sunday morning to your inbox completely for free, as well as what's gone on the market over the last few days. So click below, you can sign up and read straight away. Where you'll also be able to gain access to severely undervalued stocks for the month of September. We will be releasing October's copy in the next few days. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our updated valuation for Costco comes to $829, derived solely from the DCF, where we have the growth rate of 15%. Now as you can see, we have a low, medium and high, 10, 15, 20. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Costco or any others. But interesting to see, based on a reverse DCF, 16.4% is baked into the numbers already. So you can already see it is very costly for the company, and in terms of the growth metrics as well as the overall underlying fundamentals. And even 15% we would say is definitely on the upper end. We would typically look around 10% for a company like Costco. Having said that, using 15% and the discount rate, we get the present value of future free cash flow terminal price, add together the cash, subtract total debt, get the equity value, divide by the shares outstanding, $829. Now this indicates a downside of 9% from the current value, and for consistency, if we were to use this at 10%, it would get to 587, downside of 36, at 20%, sitting around the $1,164 mark, 27% upside. Now typically we do use the middle rate, 15%, and whilst we like to incorporate a margin of safety, using 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, it would be a buy at 746. Now this pretty much flags to us, given the price is above the intrinsic value, there is no margin of safety. In fact, you're paying a 10% premium if you're adding today. As we highlighted though, at a 10% MOS, it would be a buy, $746. At 20% is probably where we would consider this, around $663. Some investors would want to see 25% at $622, but ultimately the point here is the company, even with it trending near its 52-week lows, still looks very costly, given the valuation, given the growth, as well as the expectations moving forwards. Now Wall Street themselves, with a 4 out of 5 rating, they see this $1,090 on average into next year. That is 19% upside. But let us know, maybe you believe this is one that is a strong buy. It will continue to climb at these high valuations. In terms of using the 10% rate, which is more appropriate, we can see $587. But investors will also say this is a company that they wouldn't mind paying a bit of a premium. Using that lower growth rate, well, a 56% premium is what you can see at today's price. If you want this at a 10% MOS, well, a buy at $529. So if we see this below the $700 mark, as we said, using 15% and then applying around a 20% margin of safety, does come to 663. But realistically, you can also argue perhaps 15%, which is around the $700 mark. Let us know your views, whether you believe today Costco is a buy, hold, or avoid. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.